Today's episode is brought to you by MetaMask Portfolio. You'll be hearing more about them later on, but for now, let's get into today's interview. Happy to welcome back to Forward Guidance Jens Nordvig, founder of Exante Data and Marketreader. Jens, great to see you, man. How you doing?
Good. It's been a busy year. I can't believe. When we speak last time, was it in April?
Yeah, late spring, I think.
Yeah, so a lot of things have happened, right? That time we were talking about Silicon Valley Bank, and nobody remembers Silicon Valley Bank anymore. So many other things have happened since then.
What things are you thinking of in particular?
Well, we've had an incredible move in the yield curve, right? Just incredible move. First up in yield, and now in the last couple of weeks down. We've had obviously the attacks in Israel, right? That moved things around dramatically as well for a couple of weeks. And we continue to have just incredible moves in tech stocks, right? So lots of things going on. Yeah, I think the underlying theme really is that this cycle continues to surprise people. It's evolving in ways people didn't anticipate, including how the credit dynamics played out, right? So we have some slowing in credit, but it's definitely not played out abruptly like a lot of people feared back when Silicon Valley Bank and other banks were teetering, right? So I think a lot of things are playing out slower than people expect, right? So from an analytical perspective, it's a lot to do with, okay, when there's a trend you expect to materialize and it doesn't come at the timetable you expect, do you give up on the story, or do you say it's just because the lags are longer? That's an important thing to be aware of it right now.
Yeah, and do you extend it and say, oh, it's still going to happen, it's just going to happen in 2024, and then the spring of 2020, push it out summer?
The big debate in relation to rates is, I think, okay, now we've seen rates go up dramatically. Like a couple of weeks ago, we had the whole yield curve was at 5%, right? And that's just a remarkable thing. Like we had essentially zero interest rates for most of the last 15 years, right? And people thought, okay, tightening cycle, maybe we can get to 2, maybe 2.5, right? And we got to 5 for the entire curve. And then you start to have new theories emerge like, oh, okay, actually the US economy is not sensitive to interest rates anymore, or like some parts of the economy actually benefit dramatically from high interest rates. You always have new theories emerge when there's something very new going on. And on that front, the main point I would say is there's just some lags that are really long, right? So we can think about what's going on in the US housing market, right? A lot of people have a 30-year mortgage. So for those people who are locked into 30-year fixed, it takes a long time before they feel on their mortgage payments that we have much higher interest rates. But it doesn't mean that the interest rates don't matter. It means that it takes a long time for a lot of borrowers to feel the pain. And I think as we look into next year, that's one of the key things to really think about. Okay, how is that transmission mechanism going to play out for the government sector, for the banks, for all the different sectors that will eventually be impacted by the higher rates?
Right. So people got a 30-year mortgage at 2%. They are still paying at 2%, even though those interest rates have risen. And if they were to take out that mortgage today, it could be at 7% or 8%. How long does it take? What about the lags? Because, okay, you got 30 years, but some people prepay. Prepayment speeds were very high in 2020. I think they bottomed at like 4% or 3%. So like the actual duration is actually more like 7 years instead of 30 or something like that. So is it going to take 7 years for all this pain to be seen in the housing sector, or are you going to expect cracks to be seen elsewhere? And then there's the corporate sector. You read articles, the high yield market, they've termed out their debt. What do you think as and I should say, obviously, you're a very quantitative person.
One thing we've done at Exante is that we have calculated essentially kind of disposable income. Like, what do consumers have left, right, when they paid their taxes and they paid their mortgages? Sometimes you take out what they pay for gas as well, right? Something that's volatile, right? But the key point, really, when you do those calculations is that the mortgages roll very slowly. And the US is special, right? So if you do this calculation in Europe, in the United Kingdom, for example, essentially because a lot of people have very short-dated mortgages, you can sort of say a rule of thumb, 20% have to roll their mortgage into a much, much higher rate every year. whereas in the US, it's a way smaller amount, right? So that hit to disposable income that you've already seen in Europe, in the Eurozone, and the UK this year has just not been there. And when you look at how the US consumer has been more resilient, I think that lack of a hit to disposable income is an important factor. So that's something that I think is kind of logical, but I think a lot of people have been surprised by this year. But as we look into 24 and 25, you'll probably see that there's some countries around the world where actually a lot of mortgages have already rolled. It's a little bit too early to say that there will be that effect in the next couple of quarters. But as we look further into the future, it's kind of like they've taken the pain. The pain from high interest rates have been felt to a greater degree. And now the US is going to have a catch up. The easiest way to see it is really in the public sector, right? The US has a lot of debt. It's not that long term. Like the US government didn't term out its debt. I know Stan Druckenmiller has been pretty vocal about this, saying that Yellen traded it badly. So we could discuss whether her job is to trade and really like pump out long-term bonds when yields are low. But the bottom line is that they have quite low duration debt. And that means that a lot of debt is going to roll, right? So when we look at our calculations, okay, what's going to be the interest expenditure in the US budget as a percent of GDP? Used to be 1.5% of GDP. It could go to 3.5% over a relatively short period of a few years. That's real cash flow that is hitting the US budget, right? And US politics are complicated, so exactly that's going to be handled is perhaps not super predictable. But the bottom line is that if we want to have a stable deficit, and we're getting used to extraordinarily large deficits, like when we had a president that was called Bill Clinton, we had a balanced budget, right? That's a while ago, right? Now we've gotten used to having big deficits. 7% of GDP is kind of the recent trend, right? All else equal, if it's only the interest expense that moves, that will go to then 9% of GDP. It's just incredibly high numbers, right? So it would be logical if there is some kind of effort to generate revenue or cut expenditure to not have the deficit go even wider. It could also be that the bond market tells policymakers that it has to be like that, like it happened in the UK in the autumn of 22. But the bottom line is that interest expense is going to have real implications. And the logical implication of the high interest expense is that you have to cut something else. And that's going to then feed back into the economy, right? So the effects of these high interest rates, they don't have their full effect quickly. It takes multiple years for the shift in the yield curve that we can see on the screen immediately. It takes a few years really before the full effect of that is going through the cash flows and going into the economy. So I think when I look at the outlook for 2020 in the US economy, that's definitely something that creates downside risk to growth. We can go into that. There's quite a few things in play here. Don't forget, we had GDP that in the third quarter was almost 5%, 4.9, an extraordinary number late in the cycle, right? But also one of those numbers where you want to take a step back and think, okay, is that really the trend in the economy? Or was there something floky about that number? And I think there was. We can talk about that in more detail.
What do you think is going to happen? I mean, do you think that high interest rates are contractionary? I mean, because now there's some people who say actually high interest rates are stimulative because people who own short-term, fixed income assets, they just receive more in cash. And
Yep.
Okay, if 1% of the GDP used to be interest expense, now it's 3%. It's not like the government has to spend less money unless there is a concerted political effort, which there may be. But all these programs are still in place, and you just issue more.
Who's going to make a lot of money on the higher interest rates? So who owns a lot of cash-like instruments? So Apple, Meta, those types of companies, Google, they have a lot of those instruments on their books, and they definitely are going to have a higher interest income as a function of that happening. But are they going to spend more as a function of that? Probably not. On the consumer side, right, we're going to have some people who are kind of, should we call it wealthy, that have higher income from those types of investments. Like Jeff Bezos probably has high interest income than he used to have, right? Is he going to consume a heck of a lot more? Probably not, right? So what I'm getting at is that it really matters where on the income distribution these gains are falling. And I think any research on, excess savings broken down by income suggests that the excess savings are really being exhausted for the lower income groups, right? And we know the credit card debt is debt service on that's going up. So I think on a net basis, uh, pretty clear which direction interest rates are impacting the economy, and it's going to be felt with a lag, and it's going to be something that's going to be important for next year. I'll just make one other point, right? When we look at what's going on in the U.S. economy, you made reference to there's certain like programs that have been in place, either structural programs we have for transfers, but we also had specific programs that were invented in the COVID shock, right? So we've had a program that was an employee retention credit, right? Companies that didn't lay off workers in 2020 and 2021 were entitled to certain tax credits. And we've had a whole industry of consultants,
Yes.
accountants, and so forth popping up that help people file those tax credits this year. So essentially restating tax return for previous year, try to get that tax credit. And you can actually see those in the fiscal accounts, right? If you look at the tax credits, they had a huge spike in Q2 of this year and Q3 of this year. And I actually think that if you look at the trajectory of GDP, the fact that we had a spike in those tax credits that is literally being delivered as a check to people, it probably had an impact on the GDP trajectory, right? So when I think about what's going on now, there was something fluky about Q3. Those tax credits might have been a part of that, right? That's going to reset now. Actually, that program has effectively been shut down and totally normalized, right? A lot of things are sort of coming to an end. Special forces that were in place because of the COVID specific programs are finally running their course, right? And that's going to have an impact on the economy as we look into 24 and 25. We're going to back to a more normal world with much higher interest rates. And that's going to be restrictive overall. We also obviously have a situation where financial conditions have been moving around very dramatically in September and October. Now they come back again, but overall financial conditions are tighter, right? So that's also something that's relevant for the outlook.
Yes, they have been tightening consistently this year in the bond market. Yeah, past three weeks, stocks and bonds have rallied, so they've eased dramatically. So I don't think of you as someone who is in either camp, a recessionista or in the no landing camp. What have you been thinking about the economy? And yeah, I mean, do you think that we won't have a recession? We will have a recession, or do you think it's unknowable and that's kind of not a question that's worth asking or worth thinking about?
Well, everybody who is investing have to think about growth, right? It's the most important variable. Maybe with the exception of really high inflation as we've had the last couple of years, but growth is going to be much more important again now, right? Because inflation is out of this extreme territory that we came from, and now we have the growth variable is going to kind of drive everything. So I think it's very clear that we're heading to a lower growth period. We had some temporary factors that boosted growth in Q3. They are reversing now. As we're recording this podcast, we had home sales were the lowest in a long time, right? I think we have a number of indicators that all point to a degree of slowing. Claims is a good indicator to look at. It's a weekly indicator. We have to be very careful about how it's seasonally adjusted, right? But if we are careful of how it's seasonally adjusted, it is gradually weakening. Credit is finally weakening. Like we had a multi-month period where credit was surprisingly resilient
I remember
despite
we
the
talked about it. Yeah, in our
yeah
first meeting.
despite the shocks that we all saw and observed. Credit held up quite well in the US this summer, much better than in Europe. Like in Europe, credit is contracting, literally less credit being extended than in the past. In the US, we're going towards close to zero credit extension very recently. So that's a new thing that's deteriorated. So I think there are a lot of things that point to substantially weaker growth. I think, what does a recession really mean? To me, the key thing is that we kind of move below potential so that the labor market has some deterioration as well. That's going to put some pressure on wages. And really, for the Fed, the most important variable probably that they look at right now is what's going on with services prices, right? And it's all linked, right? If we have growth below potential, the labor market getting less tight, less pressure on wages, then they can have conviction that service price pressure is also moderating. And if that's the case, then they don't need as high real interest rates as they have now. Again, I mentioned that the whole yield curve was sitting at 5% a couple of weeks ago, right? And that was actually consistent with real interest rates in the yield curve being priced around 2.5% forever. That's pretty extraordinary. We got used to a situation a couple of years ago where there was a strong consensus that we were going to have zero real interest rates forever. Maybe we needed negative real interest rates to keep the economy going, right? And now we got to 2.5, and there was debate about whether they can go even higher. But that historically has really been something that could only happen if you had incredibly strong productivity growth. Incredibly strong, right? So the last time we had very, very strong productivity growth in the US economy and also high real interest rates was in the mid-90s. We had some years where it looked like the trend in productivity was 3-4%, right? We got used to, before the COVID shock, the productivity growth was like 1% if we were lucky, right? But the only way you really get to a situation where real interest rates are dramatically higher than what they have been over the last 15 years, if you have some kind of belief that AI is totally going to change the world, all companies are going to have massive productivity gains. And I run a company, Marketreader, where we use AI aggressively. I think it's fantastic. I'm definitely bullish on AI, but I don't think at the economy-wide level, we're going to have a situation where productivity growth is just going to explode higher very quickly. We've looked at some surveys of CEOs to just give you some data that documents that, right? And most CEOs, even if they are investing aggressively in AI, they will say, okay, we expect the benefit from these investments to be 3 to 5 years out in the future, right? So it's not something that necessarily is going to have a big impact on macro data in 24, 25. Maybe after that, there will be an effect, right? We don't know yet. And certainly it'll be odd if the Fed sets policy based on those things, right? So if you look at the infamous dot plot, right, they still have long-term nominal interest rates that are expected to be 2.5%. So call that R star or whatever you want to call that thing. So in real terms, that's just barely positive, right? So the Fed are thinking that we're going to have slightly positive, call it 0.5% real interest rates, and the market had 2.5. So you could do percentage 500% above what the Fed does are. So that's something that looked a bit extreme. And if I just say one more thing about that, right? We've been through just an incredible period over the summer here, right, where there was a huge focus on supply. For good reasons, we have big fiscal deficits. The Fed will need to sell a lot of bonds over the next many years.
And the Treasury would have to sell a lot of bonds, yeah.
A lot of bonds, yeah. Although they're trying to be careful in the sense that when they decide how many bonds to sell, they don't want to shock the market. And if they sold 20 billion of bonds one quarter, they don't want to have to sell 40 billion bonds the next quarter. So they increase the auction amounts only slightly, and they fill the gap with T-bills, right? So they've sold a lot of T-bills to avoid jacking up that auction schedule too much, right? But we've had it.
And for viewers, that's short duration instruments, which you'll just roll and the market can absorb easily. Whereas for a 30-year bond, that takes up a lot more balance sheet than a 1 month Treasury bill.
Yeah, there's just so many players that can absorb the T-bills, whereas like who is going to buy the 20-year and the 30-year? There's just a much, much narrower set of investors that actually want to do that, especially when the yield curve is, well, it was inverted, right? It still is to some degree. So there's no pickup in the long end. But we've come to a point, right, where those yield concerns were very, very prevalent. And what has ended up happening is the same that has happened in every single tightening cycle that I've studied. Like, look at all tightening cycles over the last 40 years, right? You always have a very, very close correspondence between what the short end is doing and the long end, right? So we can focus day and night on what's going to be the bond supply. But if you're doing that without paying attention to what the short end is doing, you're going to miss the rally, right? So we can discuss whether 2 years is going to rally more than the 10-year and the 30-year, but you cannot deny that those two things are extremely correlated. Historically, they always peaked almost on the same day, and it looks like in this cycle as well, right, that we've definitely had a rally in the short end and the long end coincide over the last several weeks. So that correlation is still there, despite the very legitimate concerns about the supply. You just can't dismiss that correlation. So that's something that's really important to think about, and something that's going to be very relevant to rates trading, right? And that's why when you think about those real interest rates, well, you can argue, okay, we should have some extra compensation for the supply, right? And certainly, like when I look at what's happened in the last couple of weeks, when you have a 30-year auction and then, okay, the whole yield curve spikes, 15 basis points right after the auction. Okay, that's a bit scary, and it feels a bit like an emerging market situation. But if you take a step back, you can see, okay, if the short end is under control, it still maps into the long end, right? So what I'm trying to say is you can't focus only on the supply dimension, right? It's relevant. It definitely generates vol around the auctions, but the curve is anchored on the short end, and if the economy is going to weaken, the whole curve is going to rally.
Yes, and the short end has been rallying with the long end over the past 3 weeks. I don't actually don't know about the curve, the dynamics, like the inversion. But does the rally in the short end make sense to you?
I think the key thing now for the Fed are these services prices that we spoke about a little bit, right? And we've seen some leading indicators of services prices looking better for a while, like wage growth has moderated. Various types of measures of labor market tightness have looked less tight. Global services prices have clearly flipped. So we've been waiting for some months that there was going to be an improvement in the US. And the last data we had, the last inflation data, was by far the best inflation reading on services prices that we've seen in essentially in 2 years. So when we analyze inflation, I really like to look at medians. Like rather than stripping out some category you don't like or the other category, why not just look at the whole distribution of inflation and say, okay, the median good, the one that's right in the middle distribution, how much inflation did they have there? And service price inflation, the last reading, was literally 2% annualized. So, and that's after they were close to 4% annualized for the last 2 years, right? So a dramatic improvement there. Obviously, it's just 1 month. The Fed is not going to set policy based on 1 month. But that's the first sign that things are getting really a lot better. If we have another couple of readings of services prices being essentially consistent with target or getting close to target, we don't even need to have 2% services price because goods prices are less than 2, right? So you can have 2.5% service price and the economy is still operating consistent with target. If we have a few more months of those services prices looking better, the Fed is going to be much more relaxed.
Relaxed meaning inclined to cut, going to cut, or just not hiking? Because okay, if say the 2 years rallying because we know the Fed is done hiking, which is probably true.
It's gonna be a sequence, right? So the first step is that they stop hiking, right? We've already gone through that. The next phase, which we're in now, is that they do this kind of hawkish hold, right? Where they say, okay, we don't need to hike anymore, but we're cautious, we're not sure. And that process probably going to last through the end of the year, right? And then growth is going to be key. If we have, the services prices for a couple of months looking like they are getting much closer to target, and then growth weakens at the same time, the debate about cutting is obviously going to ignite pretty quickly. Not because they're going to operate the same way as in the past, where they said, okay, economy is weak, we have to do everything we can immediately. It's not like that, but it's because rates are very, very high, right? We have 5.5% interest rates. If it feels like inflation expectations are getting totally anchored in line with target, realized inflation is getting in line with target, then we literally talk about, like just incredibly high real interest rates, right? So the debate is going to be not, we're in a panic, we need to get rates back to zero, but real interest rates are just way too high. We don't need these extremely high real interest rates anymore. And I think within a couple of inflation reports, if services prices are under control, and most likely that will happen at a time when growth is weaker, that debate, I think really it's going to heat up in Q1.
Today's interview is brought to you by MetaMask Portfolio, your one-stop shop to manage your crypto assets and access a range of Web3 services all in one place. Overseeing your crypto assets across different wallets and networks can be very complicated. MetaMask Portfolio solves this by giving you the reins to manage your crypto from a single decentralized application, or DApp. Just connect to MetaMask Portfolio to get a bird's eye view of all your coins, tokens, and NFTs, and you can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates right within the app from a vetted list of providers. No more jumping between dozens of sites and apps. MetaMask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all in one place. Manage your portfolio your way with MetaMask Portfolio. Click the link in the description of today's episode to get started. Thanks, let's get back to the interview. When you say they're high historically, I think you're talking about the like Treasury inflation protected securities. So, the nominal yield baked in, and then minus how much the market is assigning inflation will be in the future, rather than taking the rate minus what CPI was in the past. And that data exists for a long time. But I think in the late 90s, TIPS were invented. So how long is this data set going back? Like, is it possible that the 1980s real interest rates, if we had a TIPS market, would have actually been at 5%?
Yes, so you're right, obviously, that the TIPS market doesn't go back that far, right? So we have our own series that has more history in it. There's different surveys of inflation expectations that have existed throughout time. Michigan survey exists further back, for example, right? So you can create your own inflation adjusted series. I think really any way you slice and dice the data, if we're getting close to target with realized and expected inflation, then where you just look at the history of the nominal rate, it's like a long time since we had 5.5% interest rates. We certainly have to go back to the pre-global financial crisis era, right? And even there, we had periods where rates were low. So 5.5% is a high interest rate, and there's a debate about what the equilibrium interest is, right? But the Fed has not come to the conclusion that the real equilibrium is much above zero. They have not reached that conclusion. They still talk about 0.5% or something like that. So if they're comfortable with the inflation outlook, if they have concerns about downside risk to growth, it is very inappropriate to have real interest rates in the 2 to 3% range, right? So that's why, and I don't think the Fed is going to flip very quickly. So it's not something I'm saying the Fed is going to come out tomorrow and look scared and sound dovish. But I think once they get some confirmation of data, and especially once the economic data looks softer, the real issue is that you have potential for big cuts, right? Because if they start from 5.5 and they really think the equilibrium, not a loose monetary policy, but an equilibrium is 2.5, right? Okay, they have 300 basis points to do. That is to get to equilibrium. They have more than 300 basis points to do if they think they actually need to get easy, right? So we're not talking about that yet. But I think what's interesting here is that, for example, if you look at what's priced from the middle of 24 to the middle of 25, which is sort of the period where it's realistic that the easing is really in motion, right? We have around 100 basis points, right? But they could potentially do double that.
So you're more inclined to be long the 2 year than short it for sure.
Yeah, so I think we've been through a couple of years where the right trade was to trade the interest rates from the short side.
Yeah.
That's no longer the case. Like rates have clearly already peaked. We've been trading rates from the long side in Europe for 2 months now, right? So I feel very strongly about I literally can't see a scenario where the ECB hikes rates further. I can't come up with a situation where they do so, right? So that creates an asymmetric situation. They're going to fight it. Policymakers are going to fight it. They are not going to say they're ready to cut until they actually are ready to cut, right? So you have to be careful about how you read the communication. But yeah, we're definitely at a turning point for rates. We did a client call on October 10 that was about peak rates globally. I remember it's the most well-attended client call we ever did. And it was a very controversial topic, but I think it's a little bit less controversial now to say that we have passed peak. So that's how quickly the narrative is unfolding.
Yeah. And what about currencies? On this program, we've done a lot on bonds and the yield curve, but I feel like I have neglected covering the moves in the dollar and FX and currencies. And so I'm really glad you're here because I know a lot of the work that you do is on currencies. So tell us just, take us up to speed on the recent moves in dollar, and then where do you think things are headed and why?
But we just had an extraordinary summer. We talked about it with these yield moves, but it was not just the yield moves. We had a summer where U.S. growth just continued to come in better than expected. And we had these upward revisions to the U.S. outlook at the same time as everybody else were revising down their numbers, right? So very unusual to see like the biggest economy in the world going in one direction and the rest of the world going in the opposite direction. China and Europe in particular. So that led to very big moves in markets, right? When you have these type of divergences, and that's now run its course, right? So now we're heading into a situation where, yeah, we've had the peaking process in rates, the outperformance in U.S. growth has run its course. We're coming back to earth, and then the huge question for trading risk assets, for trading the dollar, is always what is the global growth dimension looking like, right? Because global growth has absolutely been weak, right? So it was actually pretty easy to trade the dollar from call it May to September, October, right? Because interest rates were going up in the U.S., global growth was very weak. Those are the most two important drivers of the dollar, and they both were sort of dollar bullish. Right now, we have a tricky situation where we have a pretty clear turn in U.S. rates. Fixed income vol is coming down, which is also something that's often important for the dollar. But the global growth dimension is very complicated, right? So we've had a period where risk premium came down and equities rallied very hard, very, very hard in November. Credit assets globally also rallied very hard. Like we had a lot of credit spread indicators that spiked quite dramatic in September, October, and then came right back. Like all the tightening was just gone in a couple of weeks. So that's sort of a relaxation trade, right? And relaxation trade often is dollar negative versus emerging market currencies against the Australian dollar and so forth. But now it feels like
what's normally dollar weak? What?
The dollar is normally weak when you have a relaxation, an improvement in risk sentiment, right? But especially versus emerging market currencies and commodity currencies and so forth. It's different if you compare the dollar against gold or the yen, like kind of safe haven assets, if you want to call them that. And right now, I think we're at a very interesting juncture where we've had this like dramatic relaxation. Risk premium have come down in the yield curve, in credit, in equity assets, right? And now we actually have to look at the data again. It's not just, I think it's fair to say that the reduction in the term premium in the bond market, like kind of was the epicenter of all the tension, right? And it generated the volatility when it was widening and generated volatility when it was compressing. But now that's kind of already played out. And now it's going to be about the data, right? So we could have a situation where this dollar weakness that has been in motion for a couple of weeks also changes nature. So instead of being dollar weak versus risky assets around the world, it becomes perhaps the dollar being weak more against the stuff that is okay when growth is weak. So it could be gold, it could be, Swiss franc, those types of assets. And I think this is something that is really important to think about when you think about the dollar. That there's not like there's $1, right? It's very different to trade dollar EM and trade dollar versus the yen. And it's different from last year. Last year we had also a big move in US rates, and then we relaxed. But then what happened was, in addition to what was happening in the US, we had China coming back from their COVID lockdowns, so that generated some growth boost. We had Europe coming out of their energy crisis because of the Ukraine war. At this point, it's a little bit hard to see, okay, where is it we're going to get that growth boost from? And that means that the composition of any dollar weakness is going to be different from a situation where it's a growth bullish move in international risk assets.
So you say dollar versus EM, emerging market currencies, is different than the dollar yen. Are you saying it's like a spectrum of which currencies are risky relative to the dollar? And the Brazilian real is a risk currency relative to the dollar, whereas in dollar yen, the yen is actually less risky and more of a risk off asset than the dollar. In other words, when there's a recessionary, and there's a crisis or something, like typically the dollar and the yen will both rally, and the yen may rally even more.
Yeah, so I think there's sort of two ways that you can create that spectrum that you're referring to, right? It could be, how correlated are they with equity assets? That would be one way to rank them, right? So Brazilian real definitely correlated to equity assets, right? Another way to think about it is, are they kind of growth currencies, right? So gold is at the other end of the spectrum. Like gold is an anti-growth asset. It performs well when we have poor growth in the world. The yen, Swiss franc kind of have that flavor as well. So very important to think about, where are we on that spectrum? It's going to be the high growth or the low growth currencies that are going to benefit. And I think this is always what is tricky about a trend, because I think it's possible that we're embarking on a weaker dollar trend, right? But the currencies that are going to be leading in that trend is shifting over time. In the initial part of the relaxation, it was the growth sensitive currencies that were leading, Brazilian real and so forth. As we kind of have had that played out, the relaxation has played out, we have to look at the data and see, are we actually getting anything on the growth front that is incrementally positive? And if that's not the case, then you're going to have currencies like dollar versus gold, dollar versus Swiss franc are actually going to be the ones that are going to be moving most. So I think that's a pretty important distinction, given how the macro environment is lining up here.
So you've got a bearish view on the dollar. What motivates that? Is it interest rate differentials or growth, or you said interest rate? You said the global growth picture, growth differentials, and interest rate differentials. Which of those three, or any or all, are motivating your bearish dollar view?
I think we can think about it as a bit of a hangover effect, right? So we've had a situation, right, where the US economy was supported more aggressively by stimulus than other economies. You can see it in the fiscal deficit. We have incredibly large fiscal deficits. And at some point, we have to pay the price. As interest rate expense goes up, the rest of the expenditure will be under pressure. That's going to be negative for growth. Same thing, you can analyze the balance of payments. Analyze the balance of payments, meaning all the cash flow in and out of the United States. As all the debt that the US has to the rest of the world rolls into higher coupon, we just literally have to send more money abroad as we pay that interest rate. That in itself could be a drag over a 2-3 year period on the current account, 1% of GDP, literally cash flow that's sent abroad. So there is some hangover from the higher interest rates when you are a debtor country, have net external deficit, and that's something that's going to come back and be relevant for the dollar. Then there are considerations around valuations, right? We've had essentially the dollar rallying since 2014. It's like pretty much a 10-year rally. The dollar is strong in a lot of crosses. People look at dollar yen, 150, used to be 80. So it's come a long way, right? Not everything is as extreme as the yen, but certainly from a valuation perspective, it's hard to argue that we're not going to be. Well, we're at an elevated position that creates some asymmetry in the outlook. But really, I think the wild card in the outlook is how strong or how weak is going to the global economy be, right? So China has a very, very hard time stimulating the economy at this point in time. So that's something that's missing from a global recovery. Europe is really feeling the effects of their tightening, right? So we have very weak growth in Europe as well. So what's missing in terms of generating a very clear bearish dollar outlook is that we don't have a bullish structural growth dimension in play, right? So it's been more about this relaxation from a very negative risk sentiment as opposed to, okay, I'm really bullish China, I'm really bullish Europe. And again, that means that any kind of dollar weakness you're going to have is going to have a little bit different composition from all the dollar bear markets we've seen in the history.
So yeah, we're filming this on Tuesday, November 21st. It will likely air on Thursday, Thanksgiving, the 23rd. You're saying, is it your dollar bearish view? Is this a short term, more of a trading view, or a longer term view? Like, what's the time frame?
In the short term, there's some very interesting dynamics in play, right? Because after that dollar rally we had over the summer, like we have certain systematic players in the market are extremely long dollars. So there's some very big unwinding potential there. We have models that crunch that day and night, right? That unwinding potential, dollar selling from CTAs is very large, historically large right now. We're also into the end of November. There's also so-called rebalancing flows that could actually be very dollar negative. So there's sort of a confluence of, I wouldn't call them fundamental forces, right? But like technical forces that are actually very dollar bearish right now. So that's sort of one aspect. So I'm trying to sort of separate the short term and long term. In the short term, I think there's definitely some asymmetry to the downside for the dollar. And then the question is really, do you want to actually turn whatever trading you have on the dollar now into a more structural bet? And I think for now, what is missing in order to get really aggressive on any kind of dollar bearish views is that the global growth narrative is hard to get super bullish, except in specific pockets.
Why is higher interest rates bearish for the dollar? Because you have to send more, the U.S. government sends more cash abroad because it's better. But what about all the dollar-denominated borrowers offshore who are sending their dollars, in some cases to the U.S.?
Yeah. Well, so you make a good point. When you look at the balance of payments, you certainly have to look at both the assets and the liabilities. Right. So when you do this type of analysis, obviously pay attention to not the gross debts, but the net debts, right? And since the US tends to run a current account deficit, it will tend to run up external liabilities faster than external assets. So we haven't seen that effect in the balance of payments yet. So it's again one of these lags where the hangover from the yield curve having shifted. And in the period where the yield curve shifts higher, it's actually dollar bullish, right? People like to get paid more in money market instruments and so forth, right? But eventually, as all the debt rolls into higher coupon instruments, it will have an impact on the balance of payments. And this is another example of these lags that we're talking about. It takes a long time before the real implications of a yield curve sitting at a much higher level maps into all the cash flows. And from a cash flow perspective, that bill, if you will, from the yield curve shifting over the last couple of years is going to be in the region 1% of GDP in terms of cash flow that has to be sent abroad, just simply paying the coupons on the bonds outstanding once they rolled.
Right. I alongside Joseph Wang, I interviewed Robert McCauley, formerly of the BIS. I think he said that even though there's more, the US owes the rest of the world more dollars than the rest of the world owes the US dollars. But when interest expenses go up, often it imposes more stress on the foreign borrowers in dollars because like the US government can pay its bills. Whereas if you're, a leveraged, Panamanian entity who borrowed in dollars and now, the dollar has appreciated rapidly and your interest expense has gone up, you're in trouble. And that can cause sort of a squeeze for dollars. And so last year, the U.S. led the way in interest rates rising. The Federal Reserve led the way, and that was massively bullish for the dollar. But also when interest rates collapse, when there's a risk-off thing, that can also be bullish for the dollar. And, the dollar sold off as interest rates glided higher from like the summer of 2020. So, you get that's like when people say the dollar smile, like it can be, left can be right and right can be left.
Yeah. So the dollar is a different currency to analyze than other currencies because it is the world's reserve currency. We saw it in 2008, right? That you have a mostly US driven issue, subprime crisis, and so forth, that is very bad for the United States, right? And nevertheless, the dollar rallied. So you have to respect that the dollar can behave very differently from other currencies for that specific reason. And certainly there are going to be dollar borrowers around the world that can be immensely pressured around US interest rates going up and so forth. I think the key thing to sort of think about very hard next year is, are there places where actually the debt situation is substantially better than in the United States? So I'll give a simple example, right? Mexico is an economy that operates without almost any debt. Like, it's a totally different structure, like household debt, very low, corporate debt, very low, right? So that economy doesn't really behave that differently in a situation where interest rates are 8% compared to them being 4%. That, I think, is the difference, right? That you have certain economies around the world where the interest rate really doesn't drive the growth outlook in a dramatic way, right? And they can have a degree of growth resilience. It's no coincidence, right, that the Central Bank of Mexico is still sort of in a fairly hawkish mode. We don't have any talk about cutting rates, even rates obviously dramatically higher than the US. But in the US, that's a little bit different. And I think that differentiation is something that can be more and more important, because eventually we're getting to a point where debt levels, even for a country like United States, is going to be an issue. It used to always be the case that in major economies around the world, right, debt levels, it was not really an issue. Japan has massive amount of debt, right? Has not really had debt issues as such. But I think we're getting to levels of debt where you have to be sort of sitting at the front of the chair and think about, okay, is that really going to change? And I think for the US, it's probably going to change the last, because it is the global reserve currency. But one of the most developed market in the world, i.e. United Kingdom, had this just 12 months ago, right? We had a government that announced tax cuts. The market thought, okay, this is crazy policy. We already have a too high fiscal deficit. And we had a situation where interest rates spiked higher and the currency collapsed, i.e. The British pound turning into a sort of EM type currency just from a correlation perspective. And we certainly have not had that in the US, but we should be aware that the debt level is getting to a point where correlation breaks is something that everybody should have in the back of their head, right? Because the one day the US interest rates go up and the dollar goes down at the same time, everything's going to change.
But it has to be a dramatic move.
I'm just saying debt levels are such that it's something we should have and be open-minded to. And the day it happens, I'm going to tell you the market's going to be in a frenzy. So that's a correlation to watch. I'm not predicting that's going to flip in the next couple of days, but I do think if we have a situation where US politics remains kind of disorderly, no, should we say, concerted effort to get fiscal situation under control, the risk is rising that we can have a situation where the correlation between US interest rates and the dollar can change. It's much more easier to have that correlation change if there are assets around the world that people like. It all goes back to the global growth variable, right? If there's no growth globally, it's hard to get people excited about global risk assets. But if we had that growth, if we had a recovery in Europe, if we had a recovery in China, then there'll be more pressure on the US. And that's certainly something to watch.
Hey everyone, we're about to get back in the action, but before we do, let me give you a lowdown on what's been brewing at Blockworks. Come March next year, in the heart of London, we're bringing together hundreds of the world's heavyweight asset managers. I'm talking about the big hitters, fund managers, allocators, payment providers, and the major high-frequency traders. They'll all be converging at Digital Asset Summit London, the mother of all digitally focused conferences in the institutional space. If you're curious about what the big money is up to in the digital asset scene, this is the event for you. We're diving deep into the intersection of macroeconomics and crypto, dissecting where we're at the market cycle, and we'll be getting into the nitty-gritty of real-world assets, so think stablecoins and on-chain treasuries. It's all in a mix. I'm going to be there, and so are the forward guide superstars. Michael Howell is going to be there. There's a rumor that Joseph Wang is going to be there. I don't know who started that rumor, but people are saying that. We're also getting into the minds of allocators, so you get a front row seat to what the big crypto money managers are cooking up these days. And because you're a dedicated Forward Guidance listener, here's an exclusive treat. Use code FG20 to get 20% off. Just hit that link at the end of this episode, so gear up, because I'm looking forward to seeing you in sunny London town come March. Thanks, let's get back to the interview.
When you have a US interest rates rise and the dollar sells off, that will be a day to remember. You mean in US interest rates rising relative to other interest rates, right? Because if interest rates go up globally on a single day, the dollar can sell off too. If you have a big global growth number, because it's when it goes up. But you mean interest rates?
I'm referring back to the UK debacle we had
Mhm.
with Liz Truss, right? Where what was happening with UK interest rates was clearly a function of inappropriate fiscal policy, right? And the market immediately told policymakers, this is not going to work. Bond yields much higher, currency down at the same time. It was a UK issue, and it was interesting. When that happened in the market, the prime minister out in a couple of weeks. So that's something to watch. And I don't think there's something that's going to happen from one week to the other. But we have to be aware that we have such debt levels that we haven't tried for a while. Like, just look at the auctions, right? The fact that we have to have auctions on the calendar along with economic data releases tells you a lot. There is focus on this supply. And I don't think it's the only variable. I just argued during this call, right, that the short end is really relevant. But it is a new regime we're already in. And it is something that creates a different sort of risk to the dollar that has not materialized yet, but it's a risk that is there in the background. And it's something that investors have to pay attention to.
When you say the dollar trades differently than other interest rate, than other currencies, it's its own world, so to speak. What do you mean? Like, what is the fundamental model for valuing currency A against currency B, where the dollar is different, given that the dollar versus other currencies is the dominant pair because the dollar is the world reserve currency?
Yeah. Like, as I said, I think 2008 is a very good example. We had a homegrown crisis and the dollar rallied, right? Almost any other economy that would have a homegrown financial crisis would have seen their currency weaken dramatically. That's a key difference. And it has to do with the dollar supply being sort of the anchor of everything, right? And if you have some form of contraction in dollar supply, it supports the dollar, whereas in other situations it would be viewed as something really bad, and it would generate currency depreciation. So that's the core difference. And in terms of how you analyze things, right, that's also linked to the global growth dimension, right? You can actually have a situation where US growth weakens and it impacts risk sentiment in a negative way, and it strengthens the dollar. Again, that will be very different if Mexico has that situation, Australia has that situation. Economic growth being weak in those economies would tend to take their currency down, right? So there's a kind of much more complicated link between risk sentiment and the dollar and growth and the dollar than you have for other currencies. And when I do dollar forecast, right, what tends to be my most important variable is literally global growth. And it can supersede the Fed even. So we have to be very careful. Obviously, in the last month or so, we've seen big moves in US rates, and that has tended to be the most important force, right? But to get a big move in the dollar, it tends to coincide with big changes in global growth.
Let's say that the dollar versus the euro, which is what now 1.09. So we have $1.09 per 1 euro. What's your outlook on the euro, given that Europe's economy is in a much worse place than the US, and how interest rates between the two countries are moving. If the Fed cuts interest rates or if the 2-year goes down by a lot more than the 2-year bond yield, the 2-year treasury yield. I mean, if the 2-year treasury yield goes down then by more than the 2-year bond yield, the German bond yield, is that going to be bullish or bearish for the dollar? So like, what's your view on the euro, and how does that depend on growth differentials and interest rate differentials?
So I think for the euro, gonna have to split it into time horizons, right? So in the short term, we have technical forces that actually could be quite quite bullish for euro dollar. And that could be euro buying from CTAs. We could have euro buying from real money investors as they rebalance their portfolios around end of November. But if I look beyond those technical forces, we have a situation where growth is incredibly weak in the Eurozone. Credit is incredibly weak in the Eurozone. And inflation is normalizing faster in the Eurozone than it is in the US. So a rate cut is potentially on the table for March, right? So for those reasons, it's hard for me to get very bullish on the euro beyond technical reasons. If we have a massive move globally in the dollar, the euro will always participate, but I don't think the euro is going to be leading. So that's really one of the complicating forces when you think about, okay, can we really have a big turn in the dollar? It's the fact that it doesn't look like the euro is going to be the leading force, and it also doesn't look like that China is going to be the leading force, right? So you have to find pockets. Okay, do you trade the dollar against gold? Do you trade against Swiss franc? Do you trade against emerging market currencies? Maybe a combination of those things. But it would be much easier if you thought, okay, the European economy is going to do fantastically well, then it would be a layup trade.
So what is a layup trade? Like when you short the dollar, what's the layup trade to short the dollar against?
To be honest, it's very rare to find a layup trade. But
I want a slam dunk trade, Jens, right?
Yeah,
now.
Exactly. Yeah, I think in the very short term, I think the dollar has asymmetry for technical forces, so that there might be a layup there for the next 1 to 2 weeks. But looking into next year, I think we are in a lower rate environment. And that means that the leadership in terms of which currencies, which counter assets for the dollar are leading is going to change, i.e. it's going to go away from the growth currencies and it's going to be the defensive plays, i.e. gold, Swiss franc, maybe even the yen. So that's the sort of transition point we're at. And that could be very interesting as we look into 24. Maybe it started already in the last couple of days.
Okay, so you're bullish on the Japanese yen relative to the dollar, or you're bullish on the Swiss franc relative to the dollar, bullish on gold relative to the dollar, because I put you in this risk on bucket, and risk on is bearish for the dollar. I didn't know that, but okay, so and even the Japanese yen. I mean, what do you think about the Japanese yen? Talk about interest rate differentials. You can get in the dollar 5.5%, on the yen you get less than zero. I mean, where are you going to put your money, right?
We've had an incredible move in the yen, and we've just started to peak out in the last few days, around 150. The scenario in which the yen moves a lot is one where global interest rates go down, and at the same time, we actually have persistent inflation in Japan, right? So they have to continue to normalize policy with a long lag, right? They are effectively the only central bank in the world, maybe you can say PBOC, but one of the only central banks in the world that haven't really tightened policy, right? So if it is the case that with the stimulus they have in the pipeline now, they are forced to actually continue to normalize policy, yield curve control getting fully abandoned and so forth, that could be an interesting combination. But it's a very expensive currency to be long, as you said, right? We have a 5% interest rate differential now, right? So you have to be very precise unless you are confident that we're going to have a really big structural move in rates, right? So there's a timing issue there. I think there's some technical issues playing out now again in the short term. But if you really want to catch the big move in dollar yen, you probably want to time it to the point when the market's really sniffing that rate cuts are getting close.
What are currencies where it's very cheap to be long, i.e. there's a lot of carry? Are there any carry currencies, so high interest bearing currencies, that you think will outperform the dollar?
Most of this year there's been arguments to be long Latin American countries, and the reason is Very simple. They actually got their inflation under control relatively fast in this cycle, and they can handle high interest rates. They're cautious in terms of cutting rates. So you have very nice carry in those economies. We came into this year with those currencies being cheap, so they've been some of the best currency investments for this year, right? So those have been the right trades. They come a decent way, right? So the entry points for those trades is not fantastic. I think they can probably go a bit further. And obviously, if they're just stuck, they don't move, you still make money on the carry, right? So it's not something where you have to have a big move immediately. So that's really the opposite to the yen, right? Where it has to move quickly if you're making the bet.
Yeah, it's like, and I know this is for the audience. Like, if the Brazilian real doesn't move against the dollar and you're long Brazilian real, you make money because interest rates are high, and there's a depreciation that's priced into the forward price of the real against the dollar, just as there's a appreciation priced in against the yen because it's yielding less. Okay, so and what's your level of confidence? I mean, you were saying before this interview started, sound like the CTA move, commodity trading advisors, in the dollar is pretty extreme. What's your level of confidence?
Well, so we know that essentially the dollar longs in that space got pretty maxed out over the last few months, right? So the potential for an unwind is very big. It's almost like you need something positive to happen with US data to avoid it. So I think the risk of that unwind is very big. In terms of having high conviction views, I think the area where it's hard to have conviction is in the global growth variable. I just don't see the probability of a big recovery being very high. But in terms of rates, I would say are interest rates going to go higher than 2.5% in real space? Are they going to get lower? I think we have a very strong asymmetry to lower real interest rates, right? Some kind of mean reversion back to where we came from. So in terms of constructing portfolios, that's a theme you want to have in there, whether you want to have it directly in fixed income or whether you want to have it in assets that are correlated to what's going on with that. That's a more complicated question, but I think there's very strong asymmetry there, probably especially in sort of the 5-point area of the curve where you don't have to worry so much about bond issuance premium, term premium, whatever you want to call it. So I think there's very strong asymmetry there. And I think there'll be dollar trades to do in the next 6 months. I think there's a tactical one to do in the short term, and we're looking for entry points to do the structural trades as well.
Got it. So tactically short the dollar in the short term, tactically long rates. Do you have a view on the differential? The yield curve was extremely inverted. Much of it still is inverted, but it's less so. So steepened, from a extreme inversion to less extreme inversion. Do you think it's going to steepen? How is this curve going to get uninverted? A bull steepener or a bear? I think it sounds like maybe you're in the bull steepening camp.
Yeah, I can see some bull steepening play out. I think once the Fed gets comfortable with the inflation outlook, they're going to endorse that directional rates is down, right? And that's going to trigger a big move. And there's going to be persistent concerns about the supply. So that means that perhaps we can have some steepening, right? But I think really the big the big move to capture is directional move in the whole curve, right? So I think sometimes there's too much focus on the slope, and actually the focus should be on just getting the overall directional move right. And that remains the case. And I think, just think about it this way, right? If we're at 5.5% rates and the Fed decides we need to get rates back to normal, that's 300 basis points of cuts. So we can have plenty of macro balls. So it's good to be a macro focused person because the macro shifts, the macro shocks still going to drive a huge amount of the action in the market, which is always fun.
Right. Well, it's great to have you here. Talk about your work at Exante Data. Talk to us also about Marketreader, your AI tool you've been developing to help investors. What is like the biggest or most fascinating thing your AI model at Marketreader has shown you, or an insight that's given you that you think, oh wow, I or a lot of my team or the human beings, this is really delivering something human beings can't do.
So the way I use Marketreader on a day-to-day basis is to have it tell me stuff that I otherwise wouldn't have noticed, right? So my career has been to do macro analysis for institutional investors, right? Marketreader gives me great insight into the equity market, right? We've had a bunch of retail companies in the last couple of days come out with disappointing guidance, right? So I get all those snippets from Marketreader because it explains all the moves in the market. And that's very helpful to get some micro color to supplement your macro narrative. And a lot of the advantage is that you just get a lot of information covering many more instruments that you can kind of generate as a human. But I'll just give you a very simple example of something we're developing now, and we're going to launch in the next couple of weeks. And that's what we call long-term summaries, right? If you want to look up a stock that you haven't followed day and night, we're going to have available on the platform summaries of a length of 1 month, 1 quarter. So if you say, okay, I'm interested in this stock, I'm not used to trading, just tell me what has been really the key things moving this stock over the last month. And it's going to be there in a nanosecond, right? And you can do that for all 10,000 stocks on the platform. That's just an incredibly quick way of accessing a lot of information. If you have to do that type of analysis manually, it's actually going to be so much work that you're going to end up not doing it.
So it's the macro sensitivity. So, this stock rallies a bunch when interest rates go down or when oil does this.
Yeah, it could be, for example, if you look at energy stocks, right? The system is going to tell you, okay, over the last month, energy stocks rallied a ton. They had some big moves. That was because oil prices went up, right? Then we have some big down days, driven by maybe some specific earnings releases. Like, it's just a broad-based summary of all the drivers. We do all the analysis in a 10-minute increment space, right? So we've done all the analysis in a very high frequency space. That's necessary to be analytical, be precise in the analysis. But once you've done that, once you've done all that weeding out the noise and getting to a signal-only stream, you can do incredible things with a really aggregated to sector level, economy-wide level, or take a step back and look at it over the last month, last quarter. And that's when the technology is obviously powerful, because it saves you a ton of time on doing analysis that would be incredibly tedious to do manually. So we're excited to launch that, and we're going to continue to launch new things, right? Because we can apply the technology in many, many different ways. So we're not going to be done next week if we launch a big upgrade then.
What about when you don't know why an individual stock goes up? Like, for example, when a year ago in the fall of 2022, oil prices declined, but energy stocks continued to rally. I guess the reason is people thought they were underweight energy and wanted to buy more energy stocks. Mm-hmm. And what would a model, and I'm not critiquing Marketreader, but just the act of trying to find out what moves in the individual stock, it can be very hard. Like, what if there's no, what if it's all noise and there's no signal?
So actually the feedback we get from users is that they like to have a consistent framework. And if we know that the Marketreader technology goes through the different dimensions of price action, news, cross-asset correlation, events, flows, and so on, and couldn't find a good explanation, that actually is helpful in itself. Then we will say, okay, there's a stock that is moving a decent amount here. Yeah. Actually, we went through all the models and there was no obvious reason why. That rarely happens, but that in itself is good information. And we should be honest about that, as opposed to trying to come up with, some random explanation. Like, we want to have a robust explanation, especially in the days of AI. Like, we certainly use AI in the process, right? But you don't want to put too much pressure on the AI. You want to say, if you've gone through the method and there was nothing, the result should be, okay, this is a move that's very hard to explain. And so our explanatory power with all our models, it call it like 90%, right? So there might be 10% where we say, okay, this was hard to explain, but we're okay with conveying that because we know our models are sound.
Good answer. Yeah. Maybe is it also a time where, okay, every bank is rallying, except there's one bank that's not rallying. That's interesting. And that's for idiosyncrasy.
Absolutely. So we have correlation models like that. So, okay, if you pick one asset and you look at everything that's normally correlated, and you see one that's standing out, then that's a kind of almost like a screening device to figure out, okay, what the heck's going on over there. So that's certainly a specific way to use the tool.
Yeah. Well, Jens, thank you so much for joining us. People can find you on Twitter at @Nordvig. And thanks everyone for watching.
Thank you very much.